We're on session 8, which is on inventory. Specifically, we're going to look at two techniques. One is job order costing, and the other is activity-based costing. The comment is, when I ask you what our inventory is, whatever is not an acceptable answer. Well, hopefully after today, you'll be able to do a better job of accounting for inventory than this clerk. Our learning objectives for Module 18, which you'll note is not the entire chapter, is on job order costing. First, we'll look at comparing the inventory costing for three types of organizations: service companies, merchandising corporations, and manufacturing organizations. Second, we'll look at the flow of costs and the financial accounting and reporting that comes with it. Third, we'll look at the production environment and the product cost systems. And finally, we'll do the exact process for one of the inventory methods, the job order costing method. Learning objective 1 is different organizations have different types of businesses and earning processes. First, we'll look at service organizations. Do they have inventory? Well, they have some supply inventory, but they basically sell their work, their labor. Second is merchandising. They do have inventory, but their inventory is purchased from others and is ready to sell. They are retailers of previously manufactured items. Third is manufacturing, and these people do manufacture products. As you might imagine, the most complex is the manufacturing. Let's look at the inventory costs. First, if we had a service business, there's no product sales. They sell service, their time or their outcomes. The inventory they do have is supplies. It could be paper, pencils, etc. Second is we'll look at retailers. Retailers have inventory. If they're a clothing retailer, they'll have shirts and jackets and pants, etc. But they buy those from someone who manufactures them and they resell it to their customers. Third are manufacturers. They actually have manufacturing. And notice that there's a lot more boxes in the bottom green here than there is for the other two. We have raw materials, things that you use to manufacture your product, work in process, which is while it's in the factory. The finished goods, think of it as a warehouse where you put all your finished goods that are ready to be sold. And the last box on the far right there is cost of goods sold, which is what happens when the customer buys it. Notice also that this section here represents assets and this section here is expense. For a manufacturing entity, a lot of work is done accounting for what they have while they're manufacturing and before they sell their product. In addition to the direct inventory items, we also have manufacturing supplies, which is also inserted into the work in process inventory. And they too may have office supplies that they expense, but usually a relatively small dollar amount in comparison with all the costs it takes to make their products. Notice that in all three of these cases, the inventory starts off as an asset and then eventually moves over to expense when they use up the item or that it's transferred to another party. What are the role of product costs? Well, first of all, it's crucial to a company's success. We look at the product profitability to see if we're manufacturing products that are suitable to customers and they pay a good price for it, and we can measure our margin. Second, we'll look at organizational performance. We'll look at one product line versus another, or one department versus another, and see who is generating the most profitable operations. Next, there are dangers of unreliable information. First of all, you may be acting with bad data, so you'll be pricing your product incorrectly, either too low or too high, both of which are problems. Next, you may make wrong conclusions about performance. You may think a product is doing great when in fact you're losing money. And finally, you may have bad decisions regarding product mix. Let's say you have three different products A, B, and C. You may be pushing through your merchandising and marketing efforts the wrong product and actually selling the lesser profitability goods instead of the one that makes you the most money.